All right, welcome back. We're continuing our series on the mistakes that people make with their money. And some of these mistakes, as an investor, you only own part of some of these mistakes. Some of them are self-inflicted, but some of them are really more the result of not paying attention enough or being diligent enough. And I don't want this to come across the wrong way, but it's really important, and this is the next one in our series, is to make sure that you don't pay an excessive amount in fees, because fees really add up. And it's very curious how this can be missed. I suppose it's just because of out of sight, out of mind, or maybe not looking or understanding well enough. And that, I think, probably most importantly, it is that the financial services industry does a poor job of explaining fees. They have it buried in that big, thick prospectus thing that nobody reads. They are written in legal jargon. They're written by attorneys for attorneys, because if there's a lawsuit, wait a minute, it was in the prospectus that we told the person to read. Page 472, subchapter 5, subchapter 2, subchapter A, B, come on. So you have to ask. That's going to be the bottom line here. Now let me fill in some of the details. One of the things that trips people up about fees is that they come in a lot of different forms, and some of it is easier to figure out than others. Most importantly, you just need to find out what it is. So let me give you some details and explanation on this. First, there are some major categories of fees that you can be on the lookout for. Custodial fees, transaction fees, product fees, and advisor fees. Those are some of the major top categories. There's probably a couple other categories, but those are the top four that I would recognize as being the ones to pay attention to. Now, let me tell you right up front, nobody, no how, no way, is going to manage your money for $50 a year, okay? So if you think, that annual custodial fee that you're charged for the custodian, the company that holds the money, that's what the custodian is, the actual company that holds the money, if you think that fee is all you're paying, it's probably not. Well, what's a custodian? They hold the money. What are some examples? In no particular order, no favoritism here, just some names you'll recognize: Fidelity, Vanguard, Ameritrade, Scottrade, E-Trade, Schwab. Those are all custodians. They are investment brokerage firms. They are regulated. They are have all the proper licensing, but their big thing is that they hold the money. They hold the account. They may not be advising you. Some of them also advise, but often with custodians, you have an advisor as well. There might be another brokerage firm involved. So there could be multiple layers that you want to understand, but you're not going to get much for $50 a year. So if that's your understanding, take a closer look. Transaction fees. Okay, this is a big one. There's a couple different types of transaction fees. First, there's what's called the dealer markup. What is that? Okay, most people don't know what this is. Dealer markup is what a brokerage firm is going to charge you for buying a security that they own. In other words, they have it in their inventory. Brokerage firms, some of them, not all, but some of them have what they call an inventory of securities that they have purchased and they're holding, and they make available to you. So they are basically selling their own inventory or things that they are holding as an investment to you. So let's say that they bought it for 10 and they can sell it to you for 15. They make the difference. That's called dealer profit. Well, there's nothing wrong with that. If they bought it at 10 and the market has gone up and they can sell it to you for a current price of 15, because that's what the market is willing to pay in general, then there's nothing wrong with them making that $5. But you just need to know that that's what's happening, because in that transaction, are they looking out for you? Are they acting on your behalf? Or are they selling something that they own to you? And what are their responsibilities in that relationship, in that type of transaction? Now, as long as all disclosed, fine, but make sure you know that they're not acting in a fiduciary capacity and selling that to you. And here's my question. It's really an aside, but I think it's important. If it's so good, why are they selling it to you? Why aren't they keeping it in inventory? That's just a natural question I would have, but I'm a skeptic, so that's just maybe something that you can think about. Now, another type of transaction fee that often is not discussed is what's called a spread. A spread is primarily with bonds, and that's where the brokerage firm dealing with the bond, the dealer, broker-dealer, dealing in the bonds will buy the bond from you at a different price than what they'll sell it. The car analogy is good. You're trading your car in, they'll buy it from you, only give you a certain price, but they'll turn right around, it might be 10 minutes later, and sell it to somebody else for more. That difference is their spread. Happens in securities and investments as well. And then also you have the broker's commission. A broker's commission can be stated as a percentage. It may be deducted from your transaction, or it may be paid to the broker as a commission from a third party. If you buy a mutual fund or you buy an annuity, there could be a commission that is paid to the broker or to the advisor. All these things, you just want to know what they are. Now, there's also product fees. Mutual funds and annuities, as examples, very often have fees associated with them. There's nothing wrong with that. There's no free lunch. Anything that has moving parts, anything that is constructed and then made available, often will have a fee somewhere in it. You just want to know what it is, because the fees can vary widely. If I look at, for example, the cost of a mutual fund, you might be able to find a mutual fund for as low as 0.1%, an index fund, or you might, for an actively managed fund, you might see a 2% or more. But the average might be 1.3. So it varies, all over the place. Same with annuities. Some of them have fees, some of them don't. Some of them have fees that are unapologetically exorbitant, very, very high fee. But this is where knowing what those fees are is so important. So the key is to know. And last but not least, advisor fees. Advisors charge for the advice they give. Now, if they are paid by a company for putting you into, for example, a mutual fund or life insurance, long-term care, or an annuity, or some other, a real estate investment trust, a REIT, if there is compensation already built into the transaction, number one, you should know what that is. Number two, you shouldn't be double dipped. In other words, you shouldn't have to pay the advisor a fee to put you into something that they're going to get paid compensation on. So just need to make sure you're clear what role the advisor is taking. And again, you also really need to know what that fee is. Advisors, their fees will vary. It might be, depending on the size of your account, as much as 2% a year or more potentially if you have a smaller account, or you could be looking at 1% if you have a larger account. It just depends on how much money you have. But again, most importantly, take this with you. You will plan stronger if you do. Know what the fees are, and if you know the fees, you can be a better consumer, more knowledgeable, and your finances can be in a better place.